Welcome back to the Mountain Morning Show. I'm joined by Travis McGhee of FuturesANIMal. Hello, sir.
How you doing, Joe?
Doing well. How are you?
I'm doing good.
I've been interested in watching the market the last couple of days because, of course, it's been a little tumultuous again.
Yeah, it has. It's been relatively flat too, which is surprising because we do have still quite a bit going on with Russia and Crimea and Ukraine. It really hasn't had too much of a downside impact on the market. If anything, the market keeps going up. I was looking at the pre-market numbers before coming on the show, and we were up substantially in both the S&P and Dow. So we keep grinding higher.
We're all going the right direction, which is the part that matters, right?
Yeah.
But yet there are still people who are still standing on the fringe, waiting, and this is because sometimes they come upon some interesting questions. One, I think for most, is how much should I invest? How do I just want to get my feet wet, or do I want to just as my grandfather says, jump in with all 4 feet? Right.
Yeah, it's there's still a lot of people on the sidelines. That's certainly true, and how can you blame them with 2009 and 2008 not too far in distant memory?
This is true.
It's still a scary thing, and a lot of people are skeptical of this market, rightfully so. You hear, and we've talked about it, all-time highs and this and that, and it's really easy to get caught in that trap and to be skeptical, and folks do ask themselves, okay, well, if I'm going to invest, what is the right amount to invest?
Right.
What is the right amount for me? And by and large, a lot of times, people tend to take what I perceive to be a bad route, and they try and model what they're doing after what someone else is doing. What their friend's doing, or their brother's doing, or sister, mom, dad, and try and model their investment plan after them, which by and large doesn't work too often.
Only if everything you had matched them up were letter for letter.
There's a lot of variables you have to consider. There's a lot of variables you have to consider, and unless those variables align with that other person, what the risk and the amount that they may be dedicating to an investment plan of their own might not be suitable for what you want to do.
Absolutely.
So again, to understand what the right amount is for you, you really need to sit down and assess where you're at in your life, because again, like I said, there are a lot of different variables you need to consider. Your age. How old are you? What's your time horizon as far as what you can invest? Probably second most important is understanding risk. Understanding what, and by risk, like what are you comfortable with? What are you comfortable investing? What is it an amount that you can put aside, that you can put away, and not touch it? And you're not necessarily worried about losing it. You obviously don't want to lose it, but you can sleep at night knowing that you've got it invested away. So risk is probably where most people get caught up in that. They model their plan after someone else, and they take on too much risk. Because what I perceive as risk and what you perceive as risk could be completely different.
Well, that's the part that really separates this from gambling, is that we're taking a measured approach, or at least we should be, with everything that we do, right? That's really what this is all about. Right.
Yeah, I mean, and obviously depending on what you're trading or investing in, it's absolutely different from gambling.
Exactly.
I mean, it's not just 10% probability in a lot of cases, or whatever the case may be, or whatever the odds
are. We're not
working
against the house.
Yeah, you're not going against the house. I mean, a lot of it, especially when you're playing in the stock market and bonds, there's certainly a good level of certainty with a lot of those investments, particularly with some of the larger companies, and understanding what they do, how long they've been around, are they making money, paying dividends, so on and so forth. Understanding the risk, and again, I'm talking a little bit more outside of just an individual investment. I mean, more or less understanding risk for yourself, and
a holistic approach to it.
A holistic approach, and what I mean by that is, again, someone has, let's say, $1,000 to invest, and they go out and they buy that one stock that their buddy's been talking about that they did so well in, and they made a ton of money in, and it's a great idea, but they don't really understand the company. They don't understand the risk involved in that trade, and they're willing just to put all their eggs in one basket, and next thing you know, a bad announcement comes out or whatever, and that company's cut in half, and it was trading at $50, now it's at $25, and you've lost 50% of your investment, in a matter of days, and you're sitting there scratching your head saying, what in the heck happened? That's what sours a lot of people on the market. And a lot of that's, again, due to not understanding risk and not doing proper homework before making the investment.
And of course, the frightening side of that is someone who does that on a much larger scale.
Oh, and there's people absolutely do it on a much larger scale. And that's just pure, that's in a lot of cases, I mean, while it's not gambling, and I perceive it to be pure gambling, and that's just speculation. You know, it's 50-50 chance there. The stock either goes up or it goes down.
Right.
So, and there's a lot safer ways to play the market than doing that.
When we talk about someone easing into the market, because we have talked about that too, and even today about this, what would that mean for some people? Would that mean just getting into their 401k? Would that mean?
Well, that's a good question. You know, a lot of people, that's where they're, I guess, the confused the most, because it is kind of confusing to know where to go and what to do, is, okay, well, where do I even get started?
Right.
You know, do I go out and open one of these, Scott Trade accounts and just start trading on my own? Do I give it to a Merrill Lynch guy? Do I do this? Do I do that? Most of the time, it's right there in front of you, and a lot of people just don't know it, and particularly with majority of companies. So your 401k plan. If you have a 401k plan with your company, that is that's
You're
investing.
already in the market.
You are in the market. I know it doesn't feel like you're in the market because you're not trading the individual stocks, and you don't, you're not concerned with what Apple's doing on any given one, any given day. But you are invested in the market, and that is a great way to start. Now, again, you need to understand where you're at in your life. How much debt you have, what other bills do you have.
Right.
Are you coming out of school and you have a ton of student loans? In a lot of ways, at that age, those take priority over taking 10% of your pay and throwing it into a 401k.
Right. You have to decide whether you're going to be able to outperform what you're going to
exactly.
gain, which is
so those are the variables that you really need to understand, and that's something a financial advisor obviously can help you out with. But in a lot of ways, especially at that age, in your 20s and 30s, a lot of that you can figure out on your own. I mean, if you have $100,000 in student loans at 6.8% interest, it's probably a good idea to be throwing more money towards that than taking 10% of your paycheck and putting it inside of a 401k.
Of course, the big thing to consider there too is if you have a company match, you obviously want to take
advantage of the match. That's free money.
Exactly.
So
you
absolutely
throw that away all the time.
Absolutely, but that's not to say, again, if these other variables are a burden on you, that's not to say you can't at least get started with a little bit of money, because compounding interest and everything, it's a beautiful thing over time. So you definitely want to get started. Yeah,
I don't think anybody looks back and says, gee, I wish I'd waited longer to get into the market or start investing.
Yeah, unless it's 2009.
Right.
Obviously that was a different animal.
Yeah, you didn't want to enter that year, but any time around that would have been better.
Yeah, absolutely. So yeah, you just want to have a nice clear picture. Yeah.
When someone wants to take a look at what they're going to do with their 401k or any of their other investments and start to ease in the market, the best way to do that?
Well, there's a number of ways. So if you're looking to your 401k or just get started in the market, most 401k plans have an advisor attached to that plan. You could certainly call them, email them. They probably have online chat rooms, and you can get started that route with a 401k advisor. If you're entirely new to the market and you don't have a 401k plan and you're looking just to start small, again, you can look into companies like T. Rowe Price, Vanguard. They have nice IRA plans that you can open up, which is essentially the same as a 401k plan, and you can start dabbling in some of those mutual funds. If you're a little later in life and maybe you do have some investments, but you're looking to diversify and looking for new areas, that's where a firm like ours comes into play, helping look at alternative markets and alternative ways to generate income in a market where people are really struggling right now. So.
Absolutely. FuturesANIMal, Travis McGhee, thank you so much.
Absolutely.
Great information right there. You got to get in there and test the waters. Ease your way into the market right now. It's a good plan. All right, well, we are going to take a quick break. When we come back, there is a whole lot more coming up on the Mountain Morning Show. Chelsea joins me right back here after this.